Hey guys, welcome back. My name's Aaron. This is Czar Finance, episode 17, mutual funds. Now in today's episode, we're going to talk about the word mutual fund and what it consists of. Let's break it down. When we talk about mutual and funds, we're talking about mutual being a group of people coming together to mutually agree upon a group of funds that they can invest in together. And whenever the money of that stock or group of stocks or those funds get together and they rise with the potential to make money, everybody in the fund who has invested mutually gain profits. So an example of this when we talk about funds is, say, I'm just going to give you a quick example of the home improvement fund. For example, we have Home Depot, there's Lowe's, there's maybe McQuaid's, there's your local, well, maybe not local, but another big box retailer that's doing construction, for example. Those are a group of home improvement companies that are together that are in a classification for the home improvement and put into this fund that everyone can agree on, saying that maybe you can invest in. Another example might be a fast food fund, for example. It might not even be out there, who knows? There's a million funds that are out there, but I'm just going to give you a quick example of a fast food fund. So maybe in that fast food fund you have Wendy's, you have Burger King, you have McDonald's, you have Subway, you have a whole bunch of other fast food companies that are recognized on the stock market that are out there in a collection of funds, in a collection of stocks together in the classification for fast food fund. Now, if I want to invest in those companies thinking that the fast food market is going to make a lot of money this year, I could take maybe $100 and I can invest it into the fast food fund, and what it'll do with my $100, it will diversify or split up and take my $100 and split up the $100 into maybe $10 for Wendy's, $10 for McDonald's, $10 for Burger King, $10 for Subway, etc. And it diversifies my $100 into the fast food fund so that they're all together under that one fund. Now, whether the fund goes up or down depends upon those individual stocks that are in that fast food fund. So if Wendy's is having a great year this year, but McDonald's is not doing so well, then you have a reversal pattern in that fund. So maybe Wendy's is going well, McDonald's not doing so hot, but say Burger King and Subway are doing mediocre, it kind of evens the flow or is diversified. I'm not going to get hit hard with that one individual stock of just investing in, say, McDonald's that could have gone down and now I lost my $100, for example. It diversifies, it splits up and makes your money more, I don't want to say even, it breaks it up into a more diversified portfolio, for example. Now, as you expand in learning about mutual funds that are out there, there are different groups and different types. Like I mentioned before, the fast food fund or the home improvement fund, etc. But there are a group of classifications that I would highly recommend that you invest in. I want you to look into growth funds. I want you to look into growth and income funds. I want you to look into international funds and aggressive growth funds as well. So those are ones: aggressive growth, growth and income, and international funds. Now, when you look at those funds, those are a collection of a large quantity of stocks that are together into each one of those funds, and it will help diversify you throughout the world with the international. It'll put a lot of funds out there. Whereas the aggressive growth, maybe there's a bunch of new startup companies that are going on there that are coming and going, and it will help diversify your portfolio to be a better outstanding, portfolio in a nutshell. Now, one thing when I talk about is with funds, I want you to realize that in order to run those funds or manage those funds of those stocks that you're buying little individual shares of, you have to pay somebody to manage those funds, and usually that pay is sent to a broker to manage those funds, and those funds have a fee. Or those brokers have a fee, I should say, to manage those funds for you, and that varies in different companies that you invest in. But for example, Fidelity might charge 2% for a mutual fund. E-Trade maybe charges 1% to manage your fund, or another company maybe say, well, if at the end of the year this company makes this amount, we're going to capitalize and take amount, this X off the top, and then we're going to give it to you throughout the whole, everybody, we're going to diversify the earnings on that to everybody else and charge you an X amount. So my word of advice to you is to watch out for the funds that you're going to be possibly charged for. It is respectful to pay a fund fee for somebody to manage it for you, But just be aware that if you have, say, $100 and you over diversify your $100 into a bunch of different funds, that the service fee to maintain each one of those funds might be greater than your initial investment, and that you could be penalized and it'll hurt you by over diversifying in your portfolio. So keep it small, keep your portfolio funds or your mutual funds in a grouping of maybe 3 or 4, at most 5 funds in a total. More than that, it's going to be overkill. You're going to be inundated with fees, and it's not worth doing so. So again, growth in income, aggressive growth, and international stocks I encourage you to invest in. Now, when you're looking at these funds, these mutual funds, there is a timeline you want to keep in mind. How long are you going to be in this fund for? Are you going to be in it for a year? Is it going to be 5 years? Is it going to be 10 years? Is it going to be, maybe, you're younger and you want to invest, all the way to your 60s or 70s or even 80s or whatever. How long are you going to be in this fund? And what are the returns on that fund? So what is their average performance? And if you look at the mutual fund's average performance, they have a performance chart that's out there that you can see. It shows per year. So maybe in 1 year, it maybe gains 5% in 1 year. Maybe if you leave it in there for 5 years, it's gaining maybe 10%. But if you leave it in there for 30 years, the average performance is, 25% or 30% on returns, which is fantastic. But again, you got to leave it in there on average for 30 years. So something to consider, how long you're going to invest in that mutual fund, and what is your time frame. If you only have a little bit of time, maybe you want to be more aggressive so you can have a higher return. But if you're going to be leaving it in there for a longer period of time, maybe you want to go more of a slower growth, but growth in income type of a fund, so that way you can ride the waves that go up and down with the market if there's market turmoil throughout the world. So again, when it comes to mutual funds are a group of stocks that are comprised together in a certain category of your choosing. You can actually custom make your own funds if you'd like to, and you have to research that or ask the company that you want to do that. And you can pick and choose. When it comes time to making money with them, you can pull them in and out at any time. They're very liquid. They also earn dividends, and you can also capitalize on that funds and make money from that. Now, again, it's growth in income, aggressive growth, and international stocks that I highly recommend you invest in. Getting started with, start small. You can start out easily with $100, and it will diversify the $100. Make it automatic. Make the money come out of your paycheck, so that way you have a little sliver coming out every month automatically and investing into your mutual fund, whether it's a 401k or 403b or 457 plan. And that way your money is automatically in there every single month. It's being put away, investing, invest. And by having it diversified with a bunch of different funds, you can ride the waves, and in time you will have a larger portfolio, hopefully one day making you a multimillionaire in which you can retire and live a happy life. My name's Aaron. This is Czar Finance, episode 17, mutual funds. And on next week's episode, I'm going to bring to you guys the topic of bonds and what is bonds and how does that work. Thanks for joining me.